Okay, so let's start. We want to continue from where we left. Last time we were discussing this topic of published accounts. So let me remind you the key things we said concerning published accounts before we continue. So let me remind you the key important points. We said when you are a public company, you are required to prepare published accounts. So we asked ourselves last time, when you are preparing those published accounts, what should you include in a complete set of financial statements for publication purposes? We said there are 5 components of a complete set of financial statement. Number 1, we said is the statement of financial position, which you could also call the balance sheet. That was number 1. Number 2, we said a statement of profit or loss and other comprehensive incomes, which we discussed. We shall review that. Number 3, we said you are supposed to include a statement of changes in equity. Number 4, we said you are supposed to include a statement of cash flows. And number 5, you're supposed to include all the accounting policies that you as a company have used, and explanatory notes. What accounting policies have you used in the preparation of your financial statement? Good. Those being the 5 components that should be included in a complete set of financial statements. After that, we now started looking at how, how do you prepare these components or these statements for purpose, for purpose of publication. I told you, the way you prepare them for purpose of internal reporting, when you are preparing these financial statements for purpose of internal reporting, it's not exactly the same way you present them for purpose of publication to the members of the public. There are some slight changes on the rules on how you should present them for purpose of publication. Good. Then we looked at how do we prepare. We started with how do you prepare a statement of profit or loss and other comprehensive income, which I told you some questions will call it income statement, others will call it statement of profit or loss. No problem. But how do you prepare it for purpose of publication? We looked at the key important things that you should know when it comes to income statement. Of course, we said when it comes to sales, normally there is nothing big. There is nothing big there when it comes to sales. You just pick the figure you're normally given. But then we said when it comes to cost of sales, when you are doing this income statement for internal reporting, remember I told you, you normally show when you are preparing the income statement for publication purposes, you normally show the workings of the cost of sales on the face of the income statement. Don't forget we said you normally had to, for purpose of internal, you have to show opening stock, add purchases, less closing stock. But then we said for purpose of publication purposes, you are not required to show the workings of the cost of sales on the face of the income statement. No, we said what do? You do that calculation somewhere as a working, then you bring it as a single amount on the face of the income statement for publication purposes. Don't show the workings of the cost of sales on the face of the income statement. Do the calculation in the normal way, elsewhere, bring it as a single amount. Good. Then from there, we said you normally get the gross profit just like any other income statement. Then the second key important point we mentioned was you normally, once you get the gross profit, we normally subtract expenses. That's obvious. But then we mentioned another key important point, that when it comes to income statement for publication purposes, we said you don't list the expenses individually. You don't list the expenses individually. Don't come and tell us electricity, water, insurance, telephone, and so on. No. What did we say? We said you are required to classify the expenses according to the function they perform in an organization. And we said one category of functions that may be performed in an organization is the administration function. So we said, go find out from the expenses your company has incurred, which of them are of administration in nature. Again, once you identify all the expenses that are of administration in nature, we said combine them somewhere as a working, combine all your administration expenses somewhere as a working, and the rule says bring it as a single amount, bring it in the income statement as a single amount. So we combine all the admin expenses. We gave examples like electricity of the office. You know you use office for administration, salaries to the office workers, depreciation of office machines, all those, or office equipment, all those are examples of administration expenses. The second class or category of functions that may be performed in an organization, we said, is the selling and distribution function. Any cost incurred in the process of selling or distributing the goods that you are selling, that kind of a cost is what we classified as a selling and distribution expense. Again, don't come and show them individually on the face of the income statement. No, the rule says combine all your selling and distribution expenses somewhere as a working. Combine them somewhere as a working. Then we said you bring them in the income statement as a single amount. Good. Then from there, we said once you minus the expenses, now you get the profit from operations. That's what we said. Once you get the profit from operations, we said you minus the finance cost. And we gave an example of a finance cost as the interest expense. As the interest expense. Maybe interest on loan or interest on debentures and so on. Whatever it is. That charge, not what you paid. We said not what you paid, but the charge for the year for interest is what you show in the income statement. Once you have charged the interest, then we say the next item is normally investment income. As a company, you could have some investments which are earning you interest or income, sorry. That income could be in form of dividends. Maybe you have shares and they're earning you dividends. So dividend received, we said, is an example of an investment income. The other in form of income, we said could be interest received. Maybe as a company, you have bought some treasury bills or bonds and they're giving you interest income. Or maybe you have put some money in a fixed deposit somewhere and it's earning you interest income. Whatever is the interest income or interest received, put it there. Then the total of the investment income. Once you get the investment income and you add, then we said you get what we called profit before tax. Profit before tax. Then we said you now come and minus the tax. I told you, listen, tax can be of various types. There is what we called current tax, or we also said it's also known as corporation tax. We said it's also known as corporation tax. Some books will call it corporation tax. Others will call it current tax. Then we said you normally have to adjust that current tax with an amount called deferred tax. With an amount called deferred tax. I told you for deferred tax, there are times you may be required to add the amount of the deferred tax to the current tax amount, and there are times you may be required to subtract the amount of the deferred tax from the current tax amount, whichever the case will be given according to the question. We shall discuss that in details. But whether you're adding or not, or whether you're adding or subtracting, we did not look at that. We shall look at it in a short while. But once you adjust, get the net of the two, that is what we said becomes the tax expense. Once you minus that tax expense, you get what we call the profit after tax. Okay. Then I went further and told you, listen to this now. Went further and told you, once you got the profit after tax, you remember, I told you, when you are doing financial accounting, in the lower level, you had to come and appropriate. Out of this profit, you had to do some appropriations. We say the examples of some of the appropriations that are paid out of profit after tax include things like dividends, transfers to reserves, maybe whatever it is. So we said last lesson that once you get the profit after tax, listen to this now. We said if you are doing this income statement for publication purposes, then you don't show the appropriations. You don't show the appropriations of that profit on the face of the income statement. No. But if you are doing it for internal reporting, once you get the profit after tax, you normally subtract dividends, subtract what we call transfer to general reserve, maybe get what we normally call retained profit for the year. You normally add what we call retained profit brought down. You get the retained profit carried down. But when it comes to income statement for publication, told you that should not be done on the face of the income statement. We said you don't show the appropriations on the face of the income statement. No. We said, where do you do those appropriations? We said you do them somewhere else. And where is that somewhere else? In another statement we were calling the statement of changes in equity. Okay? It's one of the components. Good. Then I told you, now listen. I told you, if the question tells you required a income statement, then once you get the profit after tax, then we said you stop there. Once you get the profit after tax, you stop there. That is ideally the income statement, or what you can call statement of profit or loss for publication. Then I went further and said, what if the question tells you prepare a statement of profit or loss and other comprehensive incomes, and other comprehensive incomes? So we said, now you come and show what are the other comprehensive incomes. I told you, what are they? What are other comprehensive income? And we identified two. Listen, I told you that other comprehensive incomes are those incomes that you as a company you have made this year, but the rules of accounting do not allow you to take those incomes to the profit and loss. You have made a gain or there's an income, but the rule for that income does not require you, or the rule for that gain does not say take it to the profit and loss. No. The rule says you take it elsewhere, but not to the P&L. But is it a gain? Yes. The only thing is that the question or the rule of that gain says I should not take it to the P&L account. So I could not show it above there in the income statement. That is a gain. So we are saying, tell the readers of your financial statements that we have other gains that we as a company we made. It's only that we can't show them in the income statement. And one of them we gave an example for is the gain on revaluation of fixed assets. I told you, when you revalue an asset, the double entry is you normally debit that asset, assuming you are revaluing it upwards. You normally debit the asset account, maybe it's land, building. You normally debit the asset account with the gain on revaluation, and you normally credit an account called revaluation reserve. Revaluation reserve. That is what we say. So once you debit asset and you credit revaluation reserve with the gain on revaluation, is it a gain? Yes. But the only thing is that the rule says I debit asset, I credit revaluation reserve. Revaluation reserve goes direct to the balance sheet, not to the P&L, but it's a gain, whatever it is. Okay, that gain you made is a gain. The only thing is the rule does not say that I debit asset, I credit P&L. No, the rule does not say that. The rule says you debit asset, you credit revaluation reserve. Revaluation reserve does not go through P&L. Are you there? No. Good. That was one example. Then from there we gave another example of other comprehensive income. And I said whatever is the exchange difference on translation of foreign currency transactions. I told you that when you as a company, you undertake foreign currency transactions, you will be required to translate one currency to another. You will be required to translate because you are undertaking foreign currency transactions, maybe between Kenya and US dollar. So you will be required at times to translate. I don't have to go to the details. We discussed the details last time, but that's what we say. That because of the fluctuations in the exchange rate, one time, 1 Kenya shilling is equivalent to $100, 100 shillings. Another time, 1 Kenya is equivalent to $105, 105 per dollar, whatever it is. We say, because of those fluctuations, as a company, you stand either to gain or lose. Okay? Not because of any other reason, but just because of the fluctuations. I told you there are some exchange differences whose rules require that I don't take it to the income statement. I told you there are some exchange differences where you are supposed to take them to the income statement, fine, as an income or a gain, but there are some other exchange differences where you could have made a gain or loss, but the rule does not require you to take it to the income statement. Good. That's the one I'm giving as an example there. That's all I say. Good. I think, no. Oh, then of course we discuss about the treatment of debenture interest. That is not a big deal. That's not a big deal. That's what we discussed. Okay. That's what we discussed about how to treat debenture interest. That was not a big deal. Don't forget, the key thing there was don't take to the income statement the interest paid. Take to the income statement the interest charge for the year. When you are preparing the income statement and in your trial balance you have interest, you don't take the interest paid in the P&L account, you take the charge for the year. Because we said when you are preparing an income statement, you normally follow a concept we were calling the accrual concept. The accrual concept. Good. That was just information because I told you that is something you must have done in financial accounting. How to prepare an income statement and how you normally charge the charge for the year. In fact, I gave you an illustration and every one of you gave me the right answer. You remember? Every one of you gave me the right answer. So it was not a hard thing. Good. So it's from there now that I want to continue. So I've just taken a few minutes to remind you what we said. Okay? So that's what we said in the previous class on how to prepare an income statement. But I told you we had not finished the discussion of the income statement for publication. For publication purposes, we had not finished the small issues. We had not finished the small issues. And those are the issues I want to continue from there now. One of the issues I've mentioned is about cost of sales. Don't show the amount of the cost of sales as a working. 2, expenses must be shown individually, not individually. Expenses should not be shown individually. That's number 2. Number 3, the other thing we talked about was the interest, how you determine the charge for the year. Now, so I want to continue with a few other comp items regarding income statement before we look at how to prepare balance sheet for publication purposes. Good. Now, before I do the other item, let me talk to some of you. In fact, to all of you. Okay. Now, you may have your friends who are doing this subject. Tell your friends that we are having online classes. For example, as at now, we have online classes for financial management of the intermediate level. We are doing financial reporting, but tell your friends or even yourself, if you want to join our online classes for financial management, we have online classes for financial management. Also, tell your friends, we have financial reporting of the intermediate level. Those two, we are offering them at the intermediate level, the financial management and the financial reporting of the intermediate level. Tell your friends also that we have advanced financial reporting of the advanced level. Tell them we have advanced financial reporting of the advanced level. Tell them also that we also have online classes for financial accounting of the foundation level, and the one of ATD1 and ATD2, because there also we have financial accounting. So this is just for you to tell your friends who are interested in online classes that we offer these online classes, for these 4 subjects: financial management of the intermediate level, financial reporting of the advanced, financial reporting of the intermediate level, advanced financial reporting of the advanced level, and financial accounting of the foundation level, and that of ATD1 and ATD2. Now listen, it may be possible that they are not able to join the live class. If they are not able to join the live class, tell them that we also have the pre-recorded videos. We also have the pre-recorded videos for the whole syllabus, where they can buy them and watch them at their own free time. Okay? That is, if they are not able to join the live class, they can buy the pre-recorded videos and watch them at their own free time. Good. Now, if they want to reach me, they can reach me on this number, 0722 6588 0722 658875. 0722 658875. Good. That's all I wanted to mention. No, before I forget another thing, this is for you also. Now this is also for you. Listen to this now. If you have not subscribed to my YouTube channel, please subscribe. Click that subscription button down there. You may be watching this video or you're in this class and you have not subscribed. Please subscribe to my YouTube channel so that you may get notification whenever we post new videos into the YouTube. So please subscribe. Okay? Now, I hope you have liked the class so far. You can also click the like button. Click that like button below there to like the video. Okay? So you subscribe. There's a button down there where you're watching this video from. Click that subscription button if you have not subscribed. Number 2, please like the video. Click the like button to like the video. So far, I hope you have managed to get something. Now we can proceed. Good. I hope we can now proceed. Okay? Now, let me go on and now discuss another thing regarding income statement. Now, I want to take you back now to where we prepared the income statement. This was just the format of the income statement. Now, when you look at finance cost here, I told you last time that we have different types of finance cost. One example of a finance cost is what we were calling the interest, which we discussed. But is it the only component of a finance cost? The answer is no. There is something else that may be considered as a finance cost. Some questions will have it, some will not have it. Let me introduce it now. Let me introduce that which I want to introduce today. Now, listen. When a company wants to raise finances, that company can issue preference shares. You all know that there are different types of preference shares. One type of preference share is what we call redeemable preference share. Or a company can issue what we call non-redeemable preference shares. Some books will call it irredeemable preference shares. Now, let's assume company A issued a 10% redeemable preference shares worth 20 million. Company B issued a 10% non-redeemable preference shares worth again 20 million. Let me start by asking you a few questions. Now, when these two companies are preparing their balance sheet, some of you could be aware of this point that I want to ask. Some of you could be aware because you may have been taught before. Now listen to my question. Now listen. When you are presenting the balance sheet of company A and the balance sheet of this company B, will you show these two share capitals in the same place? That means, do they go to the same place when it comes to balance sheet? Do they go to the same place when it comes to balance sheet preparation? One company called A issued a 10% redeemable preference shares. Another company issued a 10% non-redeemable preference shares. When these two companies are presenting their balance sheets, or what we are calling the statement of financial position, the question is, will they present these two amounts in the same place? Where company A shows theirs, is it the same place where company B will show theirs? I want to hear a yes or no. Maybe you can chat and just tell me yes or no. Some of you could be aware. Some of you may not be aware, but I just want to see where you fall. We are saying these two companies, when they are presenting their balance sheet, will they show these two types of share preference shares in the same place? That means, is it maybe they show both of them as an asset, both of them as part of equity, whatever? That's what I'm asking. It's either yes or no. So somebody, let me hear your opinion. Will they two companies show these two amounts in the same place? Yes or no? If you are typing, if you are doing the live chat, you say yes or you say no. If you say no, I'm not going to ask you how to treat it. But I am only confirming that you either know that they are not treated the same, or you know that they are treated the same in the balance sheet. So I was saying, company A and company B, company A has issued a 10% redeemable preference share. Company B has issued a 10% non-redeemable preference share. Will they show them in the same place in the balance sheet? Listen, the answer is no. Now listen, they are not going to the same place. Before we know where they are supposed to be treated or to be shown, let me remind you what they are. These are not new terms to you. Company A issued a redeemable preference share. Maybe they issued them 10 years ago when they were raising the money. That time, they decided to issue a redeemable preference share. What does it mean? It means that when they were raising this capital or this amount of 20 million, they were telling whoever was providing them with the share, with the 20 million, those are preference shareholders, they were telling them a time will come in the future where we shall have to redeem it. In other words, we shall have to pay you back that 20 million. Okay? Emma has said no. So Emma is now agreeing that they are not supposed to be shown in the same place. Now listen. So I'm saying, company A, when they were issuing the shares, maybe 5 years ago, 10 years ago, 2 years ago, whatever it is, they told their shareholders, a time will come when we shall buy back the shares. In other words, a time will come when we shall redeem those shares. In other words, we shall pay you back your 20 million. So company A, when they were issuing those shares, listen, at that point, they had an obligation. They had an obligation to pay back the 20 million. Company B, when they were issuing these non-redeemable preference shares, maybe 5 years ago, 10 years ago, there was no promise that they are going to pay back the 20 million. They have no obligation to pay back that 20 million. Now listen. Because company A has an obligation to pay back, then to company A, that 20 million will be considered as a liability. That 20 million will be considered as a liability in the balance sheet. Meaning, where you normally show in the balance sheet, where you normally show among the non-current liabilities in your balance sheet, among your non-current liabilities, or what you can call long-term liabilities, you normally have things like 10% debentures or a loan, whatever it is. Because you must pay back your debentures. Or if it's a loan, you must pay back your loan. Same now, listen, same now we are bringing in this element of redeemable preference share. This redeemable. So we shall also have in your balance sheet among the non-current or long-term liabilities, you will have the 10% redeemable preference shares. Why? Because you as a company, you have an obligation to pay back that amount. You have an obligation to pay that amount. So whatever you are redeemable preference shares, don't forget when you are preparing the balance sheet, show them as a long-term liability. Good. When it comes to non-redeemable preference share, listen, because you as a company, you did not have an obligation to pay back, then you take them to your balance sheet as a component. You take them to your balance sheet as a component of equity. As a component of equity. Meaning what? Meaning where you normally show ordinary share capital in the balance sheet, share premium, general reserve, revaluation reserve. There also you will include the 10% non-redeemable preference shares. Are you there now? Good. So I hope I have managed to distinguish how to treat these two as far as, listen, as far as balance sheet is concerned. That if it's a redeemable preference shares, don't take it among the share capital, share premium, general reserve. No. If it's a redeemable preference share, then take it to the balance sheet as a long-term liability. Long-term liability. This is long-term liability. Why? Because you have an obligation to pay back the amount in the future. Okay? I've said, if it's an unredeemable preference share, you don't have any obligation to pay back. So take it to the balance sheet as a component of what? Equity. Good. Now, the other point. Now listen. Both of them will be required to pay dividends at the end of the year. Company A issued a 10% redeemable. They will be required to pay preference dividend of how much? 2 million at the end of the year. Company B the same. They also issued a 10% preference shares worth 20 million. By the end of the year also, they will be required to pay a dividend of 2 million. 10%. That's what they're supposed to pay. Now listen to this again. How will you treat the 2 million dividend? Do you treat it the same way? That dividend on redeemable and that dividend on non-redeemable, do you treat them the same way? The answer is no. The answer is no. You don't treat them in the same way. Now listen. That's what I want to talk about now. For redeemable, for non-redeemable, let me start with it. For non-redeemable preference shares, their dividend will be considered as an appropriation, of profit. For redeemable, non-redeemable, you show them as an appropriation. So listen, So the way you treat ordinary dividend, where I said you normally have profit after tax, and from that profit after tax, you less the preference dividend on non-redeemable. The same place where you normally have profit after tax. Assuming you are preparing an income statement for internal reporting, I would have come and said, here, less dividends, one on ordinary, whatever it is. Now I come and say, here, less on preference. Okay, then I get the retained profit for the year. Good. So this preference dividend that I'm subtracting, listen, the preference dividend that is subtracted from the profit after tax, that should be the dividend on the non-redeemable, preference shares. Now listen, what about the dividend on redeemable preference shares? You treat it as an appropriation of profit? No. How do you treat it? Before I talk about how to treat it, let me just remind you what we talked about last time. If you remember, I was giving you an illustration where your company had a 10% debenture worth how much? 500,000. And we were asking ourselves, if your company has a 10% debenture amounting to 500,000, what is the charge the year for debenture interest? It is 10% of 500,000. And that interest, which is 50,000, that's what we were saying in the previous class, that you normally take it to the income statement as a finance cost. Are you there? Where you remember, here we were even doing an illustration. You can even see here, I was charging 50 in the P&L account. There were two cases. Yeah, here, 10% of 500, what we were charging as interest. Now listen, that 50 is what I said, when you are doing your income statement on a vertical format, like what we are doing now, that 50, we said, is what you consider as a finance cost. If you remember, I brought it somewhere here, where I was showing you that you normally charge the interest of 50 as a finance cost. Good. But then, listen, that is not the only example of a finance cost. Remember, I've told you, these preference shares, listen, these preference shares which are redeemable, they are redeemable. Those preference shares which are redeemable go to the balance sheet as a long-term liability. Just like debentures go to the balance sheet as a long-term liability, preference shares which are redeemable here, they also go to the balance sheet as a liability. So the interest or the dividend you pay, listen, the dividend you pay on the redeemable preference share, which we have seen is 2 million, that should be treated, listen, that should be treated as a finance cost. Listen, for the 10% debenture, you borrowed the finances, 500,000 debentures. That's what you borrowed. The cost of borrowing those debenture is the interest you pay. The cost of borrowing the debenture is the interest you pay. Now you're also borrowing by issuing preference shares. The cost of raising this finance, which is the preference dividend, also becomes an example of a finance cost. Also becomes an example of a finance cost. Good. Now, so that means, listen to this now, that means that where you normally show finance cost in the income statement, there could be two components of finance cost. One of them, we have already discussed it, is that interest. The second one now, which we are bringing in today, is what we are calling preference dividends. But not just any dividend. On which kind of dividend? On redeemable. I hope you are following. On redeemable preference share. The 2 million dividend we paid on redeemable preference share, that dividend should be classified as a finance cost. Should be classified as a finance cost. Good. So I hope you have now managed to know, listen to this now, I hope you have now managed to know how to treat preference shares, first thing you must ask yourself from the question is this company having redeemable preference share, or do they have non-redeemable preference shares? Once you know which one, then now you can proceed. I've told you, if it is redeemable preference share, take it to the balance sheet as a long-term liability. Why? Because you as a company, you have an obligation to pay back that amount. If it's a non-redeemable preference share, then I said take it to the balance sheet as a component of equity. Why? Because you have no obligation to pay back. That was point number one. Point number two is about their treatment of dividends. I've told you a short while ago that any preference dividend on redeemable preference share here, any preference dividend on redeemable preference share should be considered as a finance cost in the income statement. Any preference dividends on redeemable preference share should be considered as a finance cost in the income statement. Otherwise, any preference dividends on the non-redeemable preference share, that should be considered as an appropriation of profit in the statement of changes in equity. Don't forget, we said for publication purposes, all appropriations are normally done in the statement of changes in equity. So even this one, you will do it in the appropriation, or you do the appropriation of this dividend in the statement of changes in equity. It's still an appropriation of profit. Even there, you are going to appropriate it out of profit. Good. So I think now we can put down something on what we have already said concerning preference shares. So you can put down this subheading, so that we now put it summary notes there, and look at preference shares and preference dividends. Preference shares and preference dividends. Let's put down a summary note concerning those two items. So preference shares and preference dividends. Then you say this. Say this. If the preference shares are redeemable, 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 comma, they should be considered as a long-term liability. If the preference shares are redeemable, it should be considered as a long-term liability in the balance sheet. It should be considered as a long-term liability in the balance sheet. Should be considered as a long-term liability in the balance sheet. Please stop. This is because the company that issued them, this is because the company that issued them has an obligation. This is because the company that issued them have an obligation to pay back the preference shareholders. As put it just this way, this is because the company that issued them has an obligation to pay back that amount. Maybe that's a better statement. This is because the company that issued them has an obligation to pay back that amount. Okay? Another paragraph. If the preference shares are irredeemable or non-redeemable, put it that way. If the preference shares are non-redeemable, comma, they should be considered. It should be considered as a component. Should be considered as a component of equity in the balance sheet. Should be considered as a component of equity in the balance sheet. Should be considered as a component of equity in the balance sheet. Another paragraph. Another paragraph. Another paragraph. Any preference dividends paid. Any preference dividends, put it this way. Preference dividends, just put it that way. Preference dividends on redeemable. Preference dividends on redeemable preference shares. Preference dividends on redeemable preference shares. Preference dividends on redeemable preference shares should be considered. Preference dividends on redeemable preference shares should be considered as a finance cost. As a finance cost in the income statement. Preference dividends on redeemable preference shares should be considered as a finance cost in the income statement. In the income statement. The paragraph. The paragraph. Preference dividends. Preference dividends on non-redeemable. Preference dividends on non-redeemable preference shares. Preference dividends on non-redeemable preference shares. Preference dividends on non-redeemable preference shares should be considered as an appropriation of profit. Should be considered as an appropriation of profit. Should be considered as an appropriation of profit in, should be considered as an appropriation of profit in the statement of changes in equity. In the statement of changes in equity. In the statement of changes in equity. Saying preference dividends on non-redeemable preference shares should be considered as an appropriation of profit in the statement of changes in equity. Good. That's all about the discussion. That's all about the discussion. So finish. I want to bring in another discussion area now. Finish. I discuss another area now. Okay, so I hope you're through with the writing. Okay. When I was looking at the format, listen to this now. When I was looking at the format of the income statement for publication, I told you, once you get this figure called profit before tax, I said you have to come and minus tax. One component of the tax we said is the current tax. Let me just call it CT. Let me put the amount on the inner column, the corporation tax or current tax. In an exam, that amount will always be given, the corporation tax or the current tax. Now listen. But then I said, adjust it with an amount we were calling deferred tax. That deferred tax, I said, can be added. There are times you add it to the current tax. There are times you deduct it from the current tax. So when do you add and when do you deduct? The other question is, what is deferred tax? What is deferred tax? Now, just to introduce a little, we are going to do the topic deferred tax as a topic of its own later. But just to introduce what it is, listen, when you as an accountant, you prepare your financial statements, you normally calculate your accounting profit. Let us assume you computed your accounting profit and you found your accounting profit as 800,000. Okay? That is your accounting profit. When you take this profit to the taxman to tax you on this profit, normally he does not tax you on this profit. He has to calculate his own profit that he wants you to pay tax on, depending on the rules of taxation. You have prepared your P&L according to the rules of accounting, using the normal accounting concepts and principles. Okay? That 800 is the profit which has been computed based on the normal accounting principles and concepts. But according to the taxman, he has his own rules on how you should, listen, on how you should calculate the profit on which he should tax you. So he will apply his rules, and he might find that, according to him, you are supposed to pay tax on maybe 700. Let's assume 700. So while you thought, listen, while you thought you will pay tax on 800, maybe at 30%, 30% of 800 is something like 240. But for tax purposes, the taxman told you, you're not going to pay tax this year on 800, you're going to pay tax on 700. At 30%, that will come to 210. Listen, there's a difference of 30. Now the question is this. Listen, does it mean that as a company, I'm not going to pay this 30? Yes, I thought I would be required to pay 300. No, 240. That's according to my calculation. Me as a company. My profit was 800. Tax rate is 30%. I thought I'll pay 240. But the taxman said no. When he did these calculations, he said no, you're not going to pay me this year on 800. You're going to pay me on 700. Okay? In that case, listen, in that case, he will tell you to pay him how much? 210. The question is this. Does it mean that you as a businessman, you're not going to pay that extra 30? The answer is no. Listen, a time will come when you will be required to pay that 30. But as per the rules now, you are supposed to pay 210. But maybe according to the taxman, that 30, you are not supposed to pay it now, but he will require you to pay it also in the future. Listen, you know you should pay 240, but the taxman tells you to pay 210. Told you. Does it mean that the taxman will not require me to pay him that extra 30? The answer is no. A time will come in the future when I'll be required to pay that 30. So what do I do this year? Or in other words, what do I do now? Listen, I will defer. That's where the term deferred tax comes in. I will defer paying this 30. I will defer paying this 30 until a later date. Okay? You will defer. In other words, listen, you create a liability in your books now for that 30 to be paid in the future. Listen to this another case. Suppose in another year, listen, suppose in another year you got a profit of 900,000. But in that year, the taxman says, no, according to his calculations, you're not going to pay me tax on 900. You're going to pay me tax on 1.2, for example. So it looks like a time has come when he will ask me to pay him more taxes. I thought I'll pay tax on 900 in another year, but the taxman, according to his calculation, said, I'll pay tax on how much? 800. Or let's put it this way so that you can see it clearly. In another year, I did my calculation. I found my profit to be 700. Okay? When I took 30%, that means I'm supposed to pay him 210. This is another year now. Then, according to the taxman, he calculated and he saw his profit that year was 800. At 30%, he requires me to pay him 240. While in that second year or third year in future, I thought I'll pay 210. But now a time has come when the taxman will ask me to pay him 240. So remember, in the first year, I thought I'll pay 240. That is year one here. But he said pay 210. I paid him whatever he wanted. But the question I was answering is, does it mean that I'm not going to pay this extra 30? The answer is no. You will still be required to pay that 30. So what is the most prudent thing for you to do as a company? It is prudent you defer paying that liability of 30. In other words, create a liability now to be paid in the future. So you will transfer this 30 to the deferred tax account. You will open an account called deferred tax. Listen, you want to create a liability now to be paid in the future. To create a liability, we know liabilities is always a credit balance. Okay? You will come and credit here. You say a P&L account 30. Then by the end of year one, you will carry down the balance. That is 30. You will bring down the balance by the beginning of year two. Balance brought down 30. Look at now the second year. In the second year, I thought I'll pay tax on 700. That was my accounting profit here in year two. So I thought I'll be required to pay tax of 210. But when I took the data to the taxman, he did the computation, and so I'm going to pay tax on 800. At 30%, he now requires I'll pay tax of 240. Listen, he requires I pay an extra how much? An extra how much? 30. So this second year, the taxman is asking me to pay more. The question is this. Where do I get that extra 30? I thought I'll pay 210, but the taxman tells me to pay him 240. The question is, where will I get that extra 30 from? Listen. So what you will do in year two, you will now go and recall that 30 which you had deferred to pay earlier. In the first year, you deferred paying 30. But in this second year, now you are being required to pay an extra 30. First year, you are not supposed to pay it. So what did you do? You deferred. Why did you defer? Because you knew a time will come when I'll be required to pay it. So when that time comes, now I can see it in the second year. In the second year, I thought I'll pay 210. But in the second year, I'm now being told to pay 240. So I'm being required to pay an extra 30. So the question is this, where will I get that extra 30 from? You go get it from where you deferred it. So in the second year, now you don't transfer 30 to the deferred tax like I did in the first year. Now in the second year, you transfer 30 from the deferred tax because that's where you deferred it. So in the second year, you will now come and debit deferred tax here and you credit P&L account by 30. That is a simple illustration of how deferred tax comes in. You are required to pay, or you know you should have paid it, but the taxman says pay less. So what do? You defer paying that extra amount. Why are you deferring? Because a time will come when you know you will be required to pay an extra amount. So in the first year, you do what? You defer. So you transfer the 30 in year one to an account called deferred tax. How do you transfer it to there? You credit deferred tax, which is a liability you are creating. Create a liability, you credit, meaning you will go and debit your P&L account. Okay? In the second year, now you realize, oh, I'm supposed to pay an extra 30. Because I thought I'll pay 210. Now the taxman is telling me to pay 240. Where will I get that extra 30 from? Now go recall that 30 in the second year from where you deferred it. Where did you defer it? In the account called deferred tax. So in the second year, you now have what we call a transfer from deferred tax. You have a transfer from the deferred tax. What will be the double entry? Now you debit deferred tax because you are recalling it from there, and you credit P&L. Now, good. With that idea now, listen to this now. I want to take you back now and tell you, or we discuss, when do I add the 30 to the current tax? When do I deduct the 30 from the deferred tax, from the current tax? Now listen. To know when to add and when to subtract, it is good that you look at the income statement in a T format. I've been doing it in vertical, but let me show it in a T format. In a P&L account format, which is T format, you normally have profit before tax on the credit side. It's an income. An income is always a credit balance. Listen. Then we normally pay corporation tax, or what I'm calling current tax, on the profit. So if I'm paying something out of this profit, I cannot credit that account again. I have to debit. Current tax, listen, current tax is always debited in the P&L account. We always subtract it from the profit. That's why it's subtracted. Because profit is a credit, subtract or to reduce it, you minus. To minus, you are debiting. Now listen. So, the current tax I've said is always debited in the P&L account. But look at what we did for deferred tax in the first year. What did we do? We credited deferred tax here by how much? 30. We credited deferred tax by how much? 30. When I credited deferred tax by 30, it means I must have gone, or I must go and debit P&L by 30. So in the P&L account here, I'll come and say a deferred tax, how much? 30. I debit. Now listen. You are debiting P&L account when already there is a current tax in that account. Let us assume the current tax was 50 million. So you are debiting current deferred tax of 30 when there is already a debit of another 50 in the P&L. The question is, listen, question is, by me debiting P&L account with 30, am I increasing the 50 or am I reducing the 50? It's obvious you are increasing the 50. Are you getting? By you debiting P&L account by 30, when there is already a current tax of 50, you are increasing the debit. When you debit an account which has another debit, you are increasing that debit. So for that case number 1 now, in that year, you will come and add to the current tax year of what we are assuming to be 50. The current tax year which we are assuming to be 50, you will now add how much? 30. Then you get the tax expense to be how much? 80. Good. So, when do you add the 30? When you transfer, listen, when you transfer the amount to the deferred tax. When you transfer the amount to the deferred tax. Why? Because you must have credited deferred tax by 30. Then automatically it means you must go and debit P and L. Look at year 2. In the second year, we were recalling. In other words, we were transferring from the deferred tax. I was not required to pay the 30 in the first year. So I deferred it. Now in the second year, I'm being required to pay more than what I thought. Where will I get that extra 30? I go transfer from the deferred tax. So I debited deferred tax here, by 30 in year 2. Listen, I debited the deferred tax by 30 in year 2. If I was to prepare P&L account in a T format, then look at this one now. Being the corporation tax is on the debit, and now I am debiting deferred tax by 30. It means I must go credit P&L by 30. Come and see a deferred tax, 30. So the question is, I am crediting P&L by 30 when on the debit there is a corporation tax of 50. So the question is, when you credit an account which has a debit, are you increasing the debit or are you reducing the debit? It's obvious you are reducing the debit. Okay? So in that case, therefore, because we are doing our P&L account in a vertical format, now you come and say, corporation tax is how much? 50. What is the deferred tax? 30. Am I adding or subtracting? This time you deduct, because the 50 in the current tax or current tax is on the debit. Now you are being required to credit P&L by a 30. Crediting P&L account by 30 means you are reducing the debit amount. So you come and now say, yeah, but tax 30, you remain with the tax charge of how much? 20. Are you there? Good. Now, I hope you are getting something on when to add and when to subtract the deferred tax. I have said, listen, I have said, in the first year, I thought I'll pay 210, not 240. But the taxman said, pay 210. I knew I should pay more. But the taxman said, no. What did I do? I deferred. Another language, listen, in another language, I transferred the 30 to the deferred tax. I transferred the 30 to the deferred tax. Credited deferred tax by 30 means I must go debit P&L. Debiting P&L means you are debiting P&L account with the 30 when there is already corporation tax of 30, you increase by adding. Are you there? In the second year, I brought down the balance, 30, that I deferred last year. Now, in the second year, I am now required to pay 240, while my calculation says I should pay 210. So a time has come when the taxman is asking me to pay more than I thought I should pay. Therefore, where do I get this extra amount that I'm going to pay? I go recall it from where I deferred. So this second year, I transfer the 30. This time, not to the deferred tax, but from, I get the 30 from the deferred tax. Are you there? Good. By getting it from the deferred tax, told you, deferred tax is a liability. A liability is always a credit balance. So when you are getting something from there, you go and debit. You can't credit. When you are getting something from a liability account, you go debit. Yeah? Good. So, listen. In simple, if the examiner tells you, listen, if the examiner tells you as an additional information in the question, 30,000 shillings should be transferred to the deferred tax, what will you do? Will you add that 30 to the 50 or will you deduct? You have already agreed you do what? You add. Why? Because you are going to debit P&L and you are going to credit deferred tax. Having debited P&L account, I've said, and there is already another debit in the name of corporation tax, you are increasing the debit, so you add. Listen, in another sitting, the examiner could tell you 30,000 shillings to be transferred from the deferred tax. 30,000 shillings to be transferred from the deferred tax. Yeah? Now listen. Deferred tax, I've said, is a liability. If I'm transferring from the deferred tax, what does it mean? It means I go recall it from there. How do I recall it from there? By debiting deferred tax. By debiting deferred tax, which means I credit P&L. Okay? By crediting P&L, am I increasing the... No, by crediting P&L with a 30, am I increasing the 50 on the debit or reducing? I'm reducing. Okay? Good. One more. Listen. In some questions, you may be told last year we had a balance for the deferred tax of, let's say, 30 million. In other words, this year you began the year with a deferred tax, let us assume 40 million. Then they tell you that was balance brought down by the beginning of this year. It was the balance last year. Then they tell you, listen to this now, deferred tax to be increased by, listen, deferred tax to be increased by 20,000. Deferred tax to be increased by. So tell me this. When you are told to increase deferred tax by 20,000, will you debit the deferred tax account by 20 or will you credit the deferred tax account by 20? When the examiner says deferred tax to be increased by 20,000, it is obvious you needed to know deferred tax is a liability. So if I'm increasing a liability, it is obvious I go credit the account. I go credit the account by how much? By 20,000. Having credited P and deferred tax by 20, I must go debit P and L. We have already agreed corporation tax is on the debit. It was 50. Now I am crediting deferred tax by 20. It means I'm going to debit P and L account by how much? 20 for deferred tax. So it's obvious you will add the 20 to the corporation tax. When they say deferred tax to be increased by, say deferred tax to be increased by 20,000. Are you there? Or whatever the amount. You needed to know deferred tax is a liability, and therefore, being a liability, I'm supposed to go credit to increase it there. Credit. If the question tells you deferred tax to be reduced by, listen to the language, deferred tax to be reduced by 20,000. You go to the trial balance, find there's a balance of 40 last year, which became the opening this year. Are you there? Good. Then the question now tells you deferred tax to be reduced by 20,000. So, to reduce a liability, you can't credit. To reduce a liability, you have to debit. So you'll come and debit deferred tax by how much? By 20, which automatically means you will go debit, sorry, you will go credit P&L account by how much? 20. When it comes to P&L account here, you'll come and credit here and you say deferred tax by how much? 20. So the question is, when I'm doing my income statement in vertical format, yes, the corporation tax was 50. Will I now add the 30, the 20, sorry, or will I subtract the 20? When they say deferred tax to be reduced by 20, I had to debit deferred tax, I had to credit P&L. So to credit P&L means I'm reducing the 50 on the debit. Are you there? So you come and deduct. What am I trying to say? Listen. Listen carefully. That there is no one language the examiner would use when it comes to deferred tax. But it's you to conclude from the language he's using whether you will add or subtract. How would you know whether to add or subtract? You can follow the double entry as it is going. I started by saying, I'm summarizing now. When the question told us, transfer 30,000 to deferred tax, I told you deferred tax is a liability account. So to transfer 30 to the deferred tax, I go credit deferred tax. Okay? Meaning I have to debit P&L. You are debiting P&L by 30 when there is already a corporation tax of how much? 50. Or whatever it is, the question will give you. So you take the current tax, you add the corporation. When the question said, transfer 30,000 from the deferred tax, said You know, deferred tax is a liability. Okay? When they say transfer 30,000 from the deferred tax, then needed to know deferred tax is a liability. Transfer something from there, I have to debit deferred tax. So how to debit deferred tax by 30 means you have to credit P and L. Are you there? And yet, on the P and L debit side, there is a current tax. Now you are crediting P and L by 30. Are you increasing the current tax or are you reducing the current tax? Of course, you are reducing. That's one language. Transfer to, transfer from. The second language that the examiner can use in your exams is when they say, increase the deferred tax by 20, or deferred tax to be increased by 20. When they say deferred tax to be increased by 20, it's the same as being told transfer 22. Transfer 22 the deferred tax. It's the same language. It's just trying to coil it. Okay? When they say transfer or deferred tax to be increased by 20, we have said deferred tax is always a credit balance here. So if I'm increasing it by 20, I'll automatically credit deferred tax, which is the same as saying you're transferring 20 deferred tax. Are you there? Good. Then, of course, now that you're crediting 20 in the deferred tax, you go debit 20 in the P&L account. Debiting P&L account by 20, and yet there's a corporation tax of 250. That means you will add. If the question tells us 20,000, deferred tax to be reduced by, deferred tax to be reduced by 20,000, then you come and debit, because deferred tax is a liability. Reduce it, you come and debit. You will debit deferred tax by 20, means you credit P&L. Are you there? Good. So I've discussed the issue of deferred tax. Okay? There is nothing to write down there in terms of summary notes. There is nothing. What I just wanted you to know is to understand that language. How to treat deferred tax when it comes to income statement. Whether to add or to subtract. It depends with the language. However the examiner is calling it, just understand it. To know whether you're going to credit deferred tax so that you debit P&L, or are you going to debit deferred tax so that you credit P&L. It's the double entry that will guide you. Good. Now, so it means therefore, now listen, it means therefore, I am through with the discussion. I am through with the discussion as far as income statement is concerned for publication. I don't think I've left out anything. The two things that were remaining were to talk about the preference dividends, and now I've talked about the deferred tax. I've now talked about the deferred tax. I've said we don't have to write down anything concerning deferred tax because you just needed to understand it. We shall be doing questions. That is where you shall apply the concept. That's where we shall apply the concept. Good. Now let me go to, listen, ideally therefore, we are through with the first component. We are through with the first component of complete set of financial statements. Don't forget we have said for publication purposes, there are 5 components. One of them being the income statement, or what we are calling the profit or loss statement. That is, we have already discussed. Now let me discuss the second one. The second one I want to discuss for purpose of publication is the statement of financial position. That is the balance sheet. How do you present it for purpose of publication purposes? How do you present the income statement? No, the statement of financial position for balance sheet purposes. No, for publication purposes. Now listen. Before I talk about how to present it for publication purposes, let me just remind you what you used to do when you prepared statement of financial position in your financial accounting, which I said was for internal reporting. How are you presenting it? Listen, to prepare balance sheet, you know you had to start with non-current assets, one of them being land, both the value, building, bring the book value, motor vehicle, come and show the book value, furniture, come and show the book value, maybe investments, come and show the book value, maybe copyrights, all the fixed assets. Okay, good. Now, then you come to current assets, stocks, data, cash, bank, whatever. Then you come to equities, ordinary share capital, share premium, general reserve. Then you come to long-term liabilities and the current liabilities. Good. Now listen. That is how you are preparing your statement of financial position. Now listen. For publication purposes, there is only one change. For publication purposes, there is only one change. And the change is this. On how, listen, on how you present your fixed assets, which we are calling non-current assets. Now listen. The rule says that you normally don't come and show the fixed assets. Do not show the fixed assets on the face of the balance sheet individually. Don't come and tell the value of motor vehicle was this, furniture was this, building was this, land value was this. No. All the other sections of the balance sheet will remain the same way you know, except for that section of the non-current assets. Listen, that section, you are not required to show the assets of the fixed assets individually, like I was trying to show. No. Instead, the rule says, combine all your fixed assets somewhere. Bring them as a single amount in the balance sheet. Bring them as a single amount in the balance sheet by the name of property, plant, and equipment. Bring them as a single amount by the name of property, plant, and equipment. Okay? As a single amount. Listen. Then, listen. Then, if your company has any other fixed asset which cannot be classified under property, plant, and equipment, now we are required to show those ones individually. If your company has any other fixed assets which cannot be shown as part of the property, plant, and equipment, meaning it's never part of property, plant, and equipment, yet it's a fixed asset, that's when you now show it individually. Now, you remember, listen, you remember when you used to prepare or when you used to do the topic of depreciation. When you used to do a topic of depreciation in financial accounting, you did another subtopic under that called fixed assets movement schedule. You learned how to prepare fixed assets movement schedule, where you remember the fixed assets movement schedule had various columns, each column representing a fixed asset. Okay? Then the last column was for the total. You used to have a column for land, building, furniture, motor vehicle, and so on. Then you had to show the cost part of it, the depreciation part of it, and the net book value part of it. You remember this, okay? Now, is there an asset? Listen to this now. Is there an asset that you as a company you may have, which is a fixed asset? But that kind of a fixed asset never used to appear in this schedule. I've said this schedule has various columns. Each column represents a fixed asset. Is there an example of a fixed asset you can think of, which you also know that if you are told to prepare a fixed assets movement schedule, that asset will never appear here? This schedule is also what we call property, plant, and equipment movement schedule. It's also called property, plant, and equipment movement schedule. Some books will call it fixed assets movement schedule. Others will call it property, plant, and equipment movement schedule. Yeah? But my question is there an asset you can think of, and yet it's a fixed asset, but we never, or you never used to use it here in the fixed assets movement schedule? Yes, there are. There are. What are some of those assets? For example, you don't remember showing an asset called goodwill in this schedule. Why are you using goodwill here? To prepare this fixed asset movement schedule? No. So goodwill is an example of an asset which cannot be classified as part of property, plant, and equipment. Yet, it's a fixed asset. That's the rule now. Comes and say, show it individually. Another example, patents. If your company has patents and trademarks, obvious, you never had to show them under fixed assets movement schedule. They are not part of property. Yet, they are fixed assets. When your company has such, show them. Patents, copyrights, whatever they are. Another example, if your company owns some shares in another company, meaning you have some investments in shares of another company which you are holding for long term, that means you have a long-term investment. That long-term investment never appeared in this schedule called fixed assets movement schedule. Never had a column there. Yet, a fixed asset. Come and show it. Investments. Whatever it is. Now, listen. So, which means, I hope you have noticed, that all these other assets that I've shown there, they have something in common. The common thing is they are not tangible. You don't touch goodwill, patents, copyrights, investments. They are intangible. So in other words, I'm trying to say, once you have shown your property, plant, and equipment, now come and list the other intangible assets. Come and show the other intangible assets. Now you show them individually, like investments, copyrights, trademarks, goodwill, and so on. Are you there? Good. Otherwise, now listen, otherwise, for the remaining part of the balance sheet, it doesn't change. Same way you know it. How to present the current assets does not change. How you present the equities and the capitals does not change. How you present the liabilities doesn't change. From the way you know it, for internal reporting, that does not change. The only section I've said that changes is that section of the fixed assets. Are you there? Good. So maybe it's a summary we can put down as a small note so that you remember when you are revising. Have another subheading, balance sheet. Balance sheet. Balance sheet. Balance sheet. Then you say this. Balance sheet. Then you say this. The balance sheet for publication purposes. The balance sheet for publication purposes. Balance sheet for publication purposes is the same as that of. Balance sheet for publication purposes is the same as that of, or that for, that way, the same as that for internal reporting. Same as that of for internal reporting. Except that fixed assets, should not be shown individually in the balance sheet. Except that fixed assets should not be shown individually in the balance sheet. Stop. they should be presented as a single amount. They should be presented as a single amount under the name. It should be presented as a single amount under the name property, plant, and equipment. It should be presented balance sheet, single amount under the name property, plant, and equipment. Property, plant, and equipment. Property, plant, and equipment. Continue the paragraph. Any other fixed asset that cannot be classified, any other fixed asset that cannot be classified as part of, any other fixed asset that cannot be classified as part of property, plant, and equipment, any other fixed asset that cannot be classified as part of property, plant, and equipment should be shown individually. Should be shown individually in the balance sheet. Should be shown individually in the balance sheet. Any other fixed asset that cannot be classified as being part of the property, plant, and equipment should be shown individually in the balance sheet. Should be shown individually in the balance sheet. E.g., goodwill, patents, copyrights, trademarks, investments, etc. E.g., goodwill, patents, copyrights, trademarks, investments, etc. Good. Yeah? Fine. I think now we can stop there for today. We shall now continue with the other remaining components. We discussed them. Then from there now, we shall be able to do a few examples. Maybe for today we can stop there. Pick it up from there next time, where we shall discuss the remaining items. Once I discuss the remaining items, now we do a few past paper questions. Let's stop there for now. We'll pick it up from there next time. Bye for now. See you next time. Bye for now. See you next time.